Do billionaires pay less tax in New Zealand? A new report just out suggests that the ultra-wealthy Kiwis are paying way less tax than regular folk like you and me. But is it true, and is there a way that we could use the same tactics to pay less tax too? The IRD has just released this report about whether high-wealth Kiwis pay less tax than the rest of us. And what they did is they went out and surveyed 350 New Zealand families. Collectively, these guys are worth $85 billion. So they're talking to the likes of Sir Peter Jackson, who's worth $1.7 billion, Sir Bob Jones, who's worth almost $1.2 billion, Sir Michael Hill, worth about $300 million, and perhaps even people like Sir John Key, who's worth about $70 million. And in his speech, when he announced the report, the Minister of Revenue, David Parker, said, "For the first time, we have hard data confirming fundamental unfairness in our tax system." And the reason he said it is the report suggests that those wealthy New Zealanders pay about 8.9% tax on their income, whereas if you're an average New Zealander, maybe you earn $80,000 as a salary, you're going to be paying about 22%. So how do the rich do it? How do they pay less tax? Well, it all comes down to how you define income. So how do the rich pay less tax? Well, let's say you're Michael Hill and you're a little earlier on in your career. You've just started Michael Hill Jewelers and you're growing the business. You might pay yourself a salary, and let's just call it $300,000 for this example. You are going to pay income tax on that salary, and today that'd be about $97,000. But you also have a business. You have some assets, which is exactly like a lot of these other wealthy New Zealanders. Let's say at the start of the year, that business is worth about $10 million. And by the end of the year, you've grown it, it's now worth $11 million. So you've made a capital gain of $1 million. And of course, capital gains are not taxed in New Zealand, so you didn't pay any tax. Well, in this report, the IRD is saying both the capital gain and your salary count as income. So they'll say your total income is $1.3 million, but you've only paid $97K in tax because you only paid it on your salary. That is an effective tax rate of 7.5%. Now I'm going to come back to whether that is a fair definition of income, but first let's compare that to an average New Zealander. Let's say that you earn a salary of $80K. Right now, you're going to pay about $17K worth of tax on that. And in the report, they don't include any assets for average New Zealanders. So you've paid effectively 22% in tax. But here's the thing that both you and I know. New Zealanders own other assets as well. You don't just earn income, at least under this definition, from your salary. You might also own a house. And let's say that that house is worth $800,000. Now, houses go up and down in value. On average, it might go up by about 5%, but in some years, like recently, 2020 and 2021, houses have been going up in value by up to 30% in some cases. But let's say that your property, by the end of a year, is worth $880K. The IRD would say, well, you made an extra $80,000 in capital gain. Your total income was not $80K that you earned from your salary, it's actually $160K, but you only paid tax of $17K. So your effective tax rate was 10.8%. Now, property and other assets are one way that you can use income to, at least in the Minister of Revenue's eyes, pay less tax. And if you want to invest in property, you can book a free portfolio planning session with one of our financial advisors. The link is down in the description. Now, I need to go on a bit of a rant, but I should say that neither I nor Opus Partners, this YouTube channel, are affiliated with any one political party. We produce shows about property and property investment, and if you're into that, you should subscribe. We release new videos every Monday and Wednesday. And if you've already subscribed, you will know that both tax and property are a political football. Parties on either side of the aisle will come out with policies that impact you and me and all of the investors that we work with here at Opus Partners. But this report all comes down to what is the definition of income. And this idea that if your house or your properties or your business or your assets go up in value, that should count as income and you should potentially pay tax on that. But both you and I know that if your property goes up in value, that is not income. Nothing came into your bank account. You weren't able to go and take that equity from your home or your business and go and spend it at Burger King or McDonald's. You can't pay your kids' school fees with it. You're not able to go buy a car with it. And what I say to the Minister of Revenue is, where's the income, David? The value of your properties or your businesses or your assets went up in value, but where's the income? And I think that's what Ryan Bridge, the host of the AM show, was trying to get at when he interviewed the Minister of Revenue on the AM show.
How can you tax imaginary income?
Well, one, it's not imaginary income.
We're talking here about capital gains. We're talking about on-paper profits from an increase in a value of an asset for the most part.
Yes, in large...
Okay, which is imaginary money.
Well, no, it's not. It's income.
Now you might ask, Ed, why do you care about this? After all, I'm not worth $50 billion. I wasn't surveyed for this report. I'm not a high net worth New Zealander, and chances are neither are you. But here's the thing. It's highly likely that there will be policies that come out from this report, and there is a decent chance that regular Kiwis could be caught in the crossfire here. That if you have a couple of investment properties, you might have to start paying a significant amount of tax. Now, I don't want to scaremonger here, but I'm just trying to get across here that when you're reading headlines about really wealthy people paying less tax, it's not necessarily as simple as it seems, because it all depends on what's the definition of income.